You opened a NISA account, picked a solid Japanese index fund, and watched it grow tax-free. In Japan, that is a win. But if you also file U.S. taxes, that same tidy fund can become one of the most punishing lines on your whole return. The reason has a name: PFIC. Let's untangle it. Here is the tangle. NISA is a Japanese invention. Inside it, your investment gains and dividends are non-taxable in Japan. Money that would normally lose about 20% to tax, waived. Wonderful. But the U.S. tax code never signed up for that deal. To the U.S., a pooled foreign fund, a Japanese Toshinden investment trust, is not simply an investment. It can be a passive foreign investment company, a PFIC, and the U.S. taxes PFICs on their own harsh terms, whether or not Japan calls your account tax-free. So the wrapper that shields you on one side of the ocean can trip an alarm on the other. Quick note, this is education, not advice. We explain the Shikumi. What you do with your own money belongs to a cross-border tax professional. First, what actually makes something a PFIC? The U.S. test is mechanical, not a matter of opinion. A foreign company is a PFIC if it meets either of two tests. If 75% or more of its gross income is passive, things like dividends, interest, and capital gains, or if at least 50% of its assets are held to produce passive income. Now picture what a mutual fund actually is. It exists to hold stocks and bonds and pass the returns to you. Almost all of its income is passive by design. That is not a quirk of one fund, it is the entire shape of a fund. So a typical Japanese investment trust walks straight into the PFIC definition, and holding it inside NISA changes nothing because NISA is Japanese law and the PFIC rules are U.S. law. Second, the paperwork. A U.S. shareholder of a PFIC generally has to file Form 8621, and there is a separate annual reporting duty written into Section 1298 of the tax code, one form per fund per year. Hold 5 Japanese funds and you can be looking at 5 of these, each dense, each its own small project. Third, and this is the sharp edge, how the U.S. actually taxes it. There are 3 different methods, and they are worlds apart. The default method, the one you land in if you do nothing, is the excess distribution regime, under Section 1291. Here is its quiet cruelty. When you finally sell or take a large distribution, the U.S. spreads that gain back across every year you held the fund. The slices that land in past years are taxed at the highest ordinary income rate, not the gentler long-term capital gains rate, and then an interest charge is stacked on top, as if you had owed that tax all along and paid it late. The longer you held patiently, the bigger that interest grows. A calm buy and hold NISA fund is exactly the profile this default punishes hardest. The second and third methods exist to soften that. One is the qualified electing fund method, under Section 1295. The other is the mark-to-market method, under Section 1296. Broadly, both shift you toward paying as you go, year by year, instead of all at once with interest at the end. But here is the catch that bites people like us. The qualified electing fund route only works if the fund itself supplies specific annual figures, a PFIC annual information statement. Unless your fund actually provides those U.S. format numbers, that door may be shut regardless of what you would prefer. Which is precisely why this is not a do-it-yourself decision. Let's run one simplified invented case. No real figures, just the shape. Say you hold a Japanese stock fund inside NISA for 10 years and it grows nicely. On the Japan side, that gain is non-taxable, zero by design. Now the U.S. side. If you never filed anything and fall into the default Section 1291 method, that 10-year gain gets sliced back across all 10 years. The older slices taxed at the top ordinary rate, plus interest for the delay. Same fund, same growth. One country waves it through, the other runs a meter backward through time. That gap, not NISA itself, is the trap people walk into without knowing it was there. So what is the sober response? Homework, not advice. 1. If you file U.S. taxes and you hold or are weighing any Japanese pooled fund, including inside NISA, recognize that PFIC rules may reach it. 2. Look at what you already own. Individual stocks are generally not PFICs, but funds and investment trusts often are. 3. Before you buy more, sell, or make any election, take your actual holdings to a cross-border tax professional who handles U.S. and Japan returns together. Which of the 3 methods fits you is genuinely case by case, and getting it wrong is expensive. Notice what we are not saying. We are not telling you to sell, to skip NISA, or to pick a method. For many residents, NISA is a genuinely good tool. We are saying only this: if a U.S. filing obligation is part of your life, the fund inside the wrapper deserves a professional's eyes before, not after. This is general information, not financial advice. The PFIC rules, the forms, and the elections are complex, and they change. The primary IRS and Japanese sources are linked below, and your own numbers belong with a licensed cross-border professional. A Japanese fund can be tax-free in Tokyo and a reporting headache in Washington at the very same time. Learn which rulebook is reading your account and you stop being ambushed by it. That's the Shikumi.